We're excited to welcome you to the first episode of Can We Talk in Private? The Future Standard Research Podcast is now 5 years old, and it's been a privilege to share our views, spark interesting conversations, and feature investment leaders from around the firm. We wanted a rebrand, a name that reflects the goal of the show to bring you inside candid conversations with our experts and share our insights on private markets. My co-host, Andrew Korz, and I can't wait to continue the conversation. We hope to inform, educate, and showcase what's driving future standard thinking. If you're going to relaunch a show, you've got to have a great topic and a great guest. We've got both. Here to discuss the Midyear 2026 Private Markets Outlook, we're thrilled to welcome Future Standard's Chief Investment Officer, Mike Kelly. Mike, welcome to the show.
Alan, Andrew, great to be here.
And as always, joined by Andrew Korz, leader in investment research and co-host in podcasting. Welcome, Andrew.
It's great to be here at Midyear. Excited for the conversation.
Yeah, absolutely. And I want to get right into it. We've got Mike today. Thrilled to get your insights. A lot's happened in the first half of the year. Sometimes, years occur in just a matter of months, it feels. And it sort of feels that way this year. What did, the last 6 months maybe change in your view of things, and how did it maybe reinforce them somewhat?
So when you take a step back and you look at the first half, it's pretty incredible how resilient the market turned out to be in hindsight. We came into the year with a backdrop that had a number of concerning elements. You had high and rising inflation. You had back-end rates rising. You had a new Fed chairman coming in. And, of course, we had the conflict in Iran. And that combination, under more normal circumstances, would have been a cocktail that historically would have knocked the markets down pretty considerably, under any other normal environment. But with sentiment turning out the way it did and with strong earnings, the market saw through all of that and continued to rise to all-time highs. I think that proved to be both surprising and enlightening about how investors were looking at risk and reward. Investors in private conversations spoke quite cautiously about their concerns, about how things could get even worse, but that was not matched up by their behavior and flows. And so I think that was quite notable. Now, in the private markets, the story of the first half was really about private credit. And I'd say that was a bit of a tale of two cities, the two cities being fundamentals and sentiment. From the fourth quarter of last year, September, October of last year, when the rumblings around private credit first began, around these ideas of cockroaches and troubles in private credit, and is private credit a bubble, a topic we've all discussed at length. There were concerns that these idiosyncratic credit issues were going to bubble up into something more systemic. That never transpired. However, sentiment did run negative. There were concerns around distribution cuts at major interval funds and BDCs. There were pockets of weakness in areas like software and concerns around the disruption that AI would bring to software, which was an area of a lot of interest by some of the larger cap sponsor-backed lending groups, lending to software companies. And that kind of combination drove redemptions to high levels. And we're continuing to see redemptions in the industry in private credit funds in excess of the limitations. And so that level of negative sentiment was met with headlines that were quite hyperbolic around, SaaSpocalypses and credit Armageddons, and this is the bubble bursting, none of which really matched up against the true fundamentals. I'm looking at, default levels, broad-based losses, real credit, fundamental credit issues outside of software. And so there's really been this, dichotomy between what was feared and what is actually transpiring. That, I would argue, is still playing out today.
Yeah. It's been a peculiar cycle. This is something Andrew and I have talked about quite a bit, which is, we had this broad market correction, when rates inflected higher, but we never really got a recession. And at a macro level, begs the question, where are we really in the private market cycle? And, is a quote unquote market cycle still really the frame by which we should be thinking through sort of what's the stage of the economy right now?
I think it's a fair question around do economies and credits markets still cycle? We haven't had a true recession since the great financial crisis. I don't really count the COVID period as a true. It's more of an economic disruption from an exogenous event rather than a true economic downturn, and it wasn't sustainable. And so, in looking at that, I have to imagine that we will one day have a real recession. What will drive that is anyone's guess. It's hard to know at this point because the economy has been resilient. The consumer has hung in there. The labor markets are resilient and fairly solid. And the consumer, particularly the high-end consumer, is quite strong. I will say, though, that when you parse through the drivers of economic strength and the sustainability of that, it does feel to me as if those drivers are narrowing.
Sure.
Yeah. And we have some degree of underlying stability, but a lot of the inflection and upside in the growth is tied to the monumental spending in AI CapEx, the build out of the AI CapEx infrastructure layer. And I can't imagine that there's any separation between that, the outcome in the markets, and the high-end consumer spending patterns.
Yeah.
To me, all three of those think of them like mountain climbers who have all strung the rope to their waists, and they're all climbing the mountain together. Yeah. And God forbid one of them goes down.
So sort of taking this sort of macro view and applying it to private markets and maybe bringing in some of the content from our report, one of the governing themes in the report, sort of the big view, is the job of an allocator, or maybe I should say the primary way by which allocators affect portfolio outcomes is shifting right now, right? So the past 15 years, you've had a big range of outcomes in terms of, in terms of asset class returns, right? You've had venture, private equity, public equities do really well. And then you've had other things like cash, obviously, that hasn't done nearly as well. In that type of environment, the job of an allocator principally is to pick the right asset classes, right? Did you overweight venture, private equity? Did you underweight certain asset classes? That's really how an allocator affects portfolio outcomes in that type of environment. We think we're going to something much different, right? Where the range of outcomes for asset class returns is actually narrowing, at least at the beta level, right? You've got higher rates, right, that are increasing the expected returns for income-based strategies, while they're sort of challenging strategies that rely on leverage. You've got, I think we would say, very few entry points that look like they provide any convexity right now in the markets, right? So it looks like the sort of broad outcomes across asset classes are set to narrow, or that range is set to narrow, right? On the other hand, the dispersion within asset classes looks like it's going to expand, right? You've got things like AI, global economic fragmentation within private markets, and we can talk more about this. You've got capital concentration that's driving this bifurcation in markets, right? So you've got potentially more dispersion within private equity, within private credit, right? So that sort of begs the question, has an allocator's job, or the primary way they add value, changed from sort of like, do I overweight this, do I underweight that, to how do I get exposure to each asset class, by manager, strategy, segment? I'm curious sort of how that hits you, what maybe you'd add to it, would you challenge any of it? And for allocators thinking about portfolio construction, what does that sort of overarching theme mean?
In some ways, I think the asset allocator's job is becoming more interesting, albeit more challenging, than it has in maybe my investment career. And that's because the main regime that backs up the movement of the markets has changed so considerably from the late 80s up until, that period of COVID, circa 2021, when we began to see a number of macro shifts in rates and inflation and globalization and demographics and so forth. And I think the old school approach to allocation was almost diversification by name.
Right.
Like I have allocation to this index and this market, and if I'm in alts, well, I have some venture and some real estate and some private equity and this lending strategy that I can't even, I don't even know what to call it at the time. And therefore I'm diversified. I think now an allocator needs to step back and not think about it by name, but what is the real driver of, and what objective does it achieve? So breaking down an equity portfolio and broader allocation into what are the drivers of growth? Because that's what you're aiming to achieve with an equity portfolio, is to grow the portfolio. Right. Within your fixed income, it is what the name entails. You're there to generate income. And we haven't really talked about, in decades, a real asset portfolio, but something that protects against inflation, something that diversifies against equities and fixed income, doesn't have the degree of correlation and so forth. And so when you take a step back and start to look at the economic driver, you have to get more creative around allocating and how do you break up those three big segments into allocations and exposures that are diversifying. And because stocks and venture and private equity are rhyming more and more as time goes on, and the opportunity is concentrating on these singular themes, you have to work even harder to look beyond that and say, what kind of private equity am I getting? What kind of stock exposure am I getting? Does it really represent what drives outcomes and growth in the economy? And if it doesn't, what do I have to do to work harder to achieve that? And forget about allocating by name of the entity or name of the strategy or name of the fund manager. Really get into the underlying driver of economic return, and does it match up against the outcome you're trying to achieve?
Right. A more complex world, but in some ways perhaps one where an allocator can add more value than previously.
Exactly why I think it's more interesting but challenging is if you're really talented at it, now's the time to showcase that talent.
So maybe bringing this into private equity, where I think this idea of concentration and are you getting truly diversified exposure within your portfolio gets, the rubber really hits the road. We've talked a lot about capital concentration, right? And I would call this like really the past 5 to 10 years is when this phenomenon has really started to accelerate. I would argue you've seen fund sizes over the past 5 years get absolutely massive. First half of this year, the 10 largest funds that were raised comprised about 50% of all the U.S. private equity capital raised over that 6-month period. And the follow-on to that is you've had more and more competition for these very large, call it premium, high quality, quote unquote, assets, helping to drive the entry prices up, right? So when we look at the private equity market, it looks like it's been bifurcated into sort of the middle market, which is historically where the private equity asset class has operated and added value, and this sort of emergent, mega private equity landscape, right? How do you see that bifurcation playing out, and what does it mean to you for how investors should be approaching that asset class?
Well, I agree with that. I've observed that as well. And when you look at so many of those mega cap private portfolios and their activities, their concentration on the opportunity that is being pursued by the largest of the public companies is overlapping more and more as time goes on. And we're seeing more large growth stage private equity firms using the public market as a source of investment flow. So take privates and trying to also exit into that very same market. And so the conditions by which success accrues to the biggest names in the public markets rhymes a lot more and more with the conditions that drive success for the mega cap, private equity, and growth equity funds. Which is not to say that those can't be successful allocations. It's just those are not as diversifying from one another as historically one might have thought when they thought, hey, I'll invest in private equity because it'll diversify from some of my liquid holdings in my portfolio. And I think the opportunity that provides for players such as ourselves that focus on the middle market, we are operating in an ecosystem that has very different drivers, very different sector concentrations and exposures that have very different valuation parameters, less leverage associated with it, and don't require the public markets either for a source of investment flow or to exit your investments. And so it's an ecosystem that is operating unto itself that can be successful alongside the mega cap and stock exposures, but are diversifying from those. And so it acts as a really strong complement if an investor already has sufficient S&P exposure, NASDAQ exposure, maybe some larger mega cap private equity or growth equity exposure. That middle market private equity exposure is truly idiosyncratic and diversifying, which again goes back to that's a job of an allocator, is to ensure they actually have the diversification that they think they have. And so I think it solves for those objectives.
Yeah, I always like the idiom of the quiet compounding. I mean, it's really a case for that with the middle market. When you're in an area where that kind of vast sum of capital is not as immense and sort of overwhelming. But the topic of capital concentration and large capital being deployed into particular parts of the market and what that might mean, from an investment opportunity set, it naturally leads us into the conversation on AI. And, it's a theme that's progressing extremely rapidly, day by day. I think, there are many firms out there that are probably sitting with bated breath for the next big model release and what that might mean for them and their business models. Token spend, it's all the rage in the news. And, it's accelerated more probably than any theme in recent memory. And obviously we're not going to tackle every angle of it on this episode, but sitting here today, what are the essential AI metrics or thresholds that you're really monitoring that over the next 6 to 12 months might give you some insight into how things are going directionally?
There's no question it's the biggest platform transformational shift in our lifetimes. And we've seen quite a few, from you're talking about backing up to the advent of the personal computer, right, in the early 80s. And from that point on with the internet and mobile telephony and, the shift towards artificial intelligence, the amount of capital that's required to fund this transformation dwarfs anything we've seen in our lifetime. And so you have to be excited about it. And it's a daunting task to try to think about it. But what you have to do is look historically at all of the shifts that we've seen over, and even longer, over the last 200 years, with any kind of technological innovation and transformation. I tend to think that, the quote that always sticks out to me was, Bill Gates in The Road Ahead, which he wrote, I don't know if it was the late 80s or early 90s. And he said that most people overestimate in these technology shifts the near-term impact, but they underestimate the long-term.
Interesting.
And I would imagine this shift with AI will be no different. It will take longer than we might hope or expect some of the impact of this technological transformation to take hold and to see results, but we may underestimate its ultimate impact. Now, because of that, it lends a lot of uncertainty into where we go from here. We're already seeing it, right? Is it going to be closed source? Is it going to be open source? What will be the winning kind of paradigm? Who are the winners going to be? How will the path go? How will all of this spending end up? We're going to spend another, $6+ trillion over the next 5 years. Who are the beneficiaries of that spending? What are the use cases? Will companies start to develop ROI on the back of all of this? And which ones will be the biggest beneficiaries? The reason I say all of that is the path is uncertain and the winners along that path are uncertain. So as investors and allocators, we're making two big uncertain bets, both the path and the selection within that path. And you're compounding risk by doing it. So we should just be self-aware about that. You can take, I'll contrast where the heat of that is with the top 10 names in the S&P and all the large cap exposure you're seeing in the private markets, these pre-IPO names that are playing that infrastructure game of AI. Contrast that with middle market players. Known winners, known leaders. You see their growth path. You're not speculating whether they're going to win. They've already won. You're providing them capital to help expand their lead against their competitors. Use AI, sure.
Yeah, right.
Put AI into their business. Deploy it to make them better. Deploy it to make them more profitable. Deploy it to make their sales, their logistics, their pricing approach more sophisticated all day long. But these are known winners. You're not making the same degrees of speculating about where their refrigeration system is going to go on the path ahead. People need refrigeration systems. There's no question about it. They're already the winner. You're going to use the capital you're giving them and the application of technology to make them better at what they do. I would rather take that risk than take the double speculation game risk all day long.
And you don't need to change the world for it to be a successful investment.
No question.
Right. So you mentioned I think we're not Luddites here, right? We all believe in the transformational capabilities of this technology. You mentioned timing clearly uncertain, which when you're dealing with a market where hyperscaler free cash flows are falling, all of that, CapEx is now being migrated into the capital markets. And when you have credit involved, timing really matters, right? Whether cash flows come in tomorrow or next year can be the difference between default or no default, right? So this is obviously a hot market. We've got a digital infrastructure investing team here. When you look at this market, and clearly there is a ton of opportunity to finance some really economically impactful projects. On the other hand, there are people out there clearly doing things that are less than optimal, right? How do you find ways, A, to remain disciplined and find deal flow in this market without getting caught up in that, and B, maybe provide exposures for people's portfolio, sort of building off what you were saying, that are different than your regular way, AI beta?
You're exactly right. The SaaS revolution was magnificent in many ways because you had businesses that were equity financed. They were high free cash flow type businesses, very high margins, churning, consistently sticky revenue bases. And Silicon Valley had a history of just one round of equity financing after the other. And they were asset-light businesses, so they were capable of doing that. And you didn't have to get the timing right, to your point, necessarily, because when the next equity round came, you went out and you raised, passed the hat and you raised more capital. But you're right. Now, this type of technological transformation is much more asset-intensive, and the amount of capital is mind-numbing to think about. It requires a lot more credit financing. Both investment grade and non-investment grade type credit. And so it's a more sophisticated capital structure approach to making these investments, deploying assets, purchasing hard assets, amortization, all of that. And so we're in a different kind of paradigm with the companies and the types of investments that we're seeing. When you look at strategies like our digital infrastructure strategy, Michael Bogdan and team are not underwriting projects for the most part where you're going to have, tremendous upside potential, but with the prospect of underwriting at zero. They're looking at investment opportunities where they have clear collateral protection, secured and contractual income. They can offlay risk that they don't want to underwrite through lease terms and so forth. They can bring a hyperscaler in to one of the projects they're underwriting to collar the outcome, so to speak, and generate really attractive level of returns. Still tremendous returns in the context of the investment opportunity, but one where even if things don't go precisely as planned or take a little bit longer to transact, or if there's a change in the application of the models and the economic pricing of the models, that their investment is still highly secure and the outcome is highly secure. That is, we're isolating risks that we want to take, that we can underwrite, we can contract. And this is not just in Michael's strategy, but in our private credit strategies and our private equity strategies, where we define what risks we're willing to underwrite, what an upside and downside case will look like, and not play the role of venture capitalist of, we're hoping there's one or two or three really good investments and we assume the other ones, a lot's going to go wrong.
Right. So the other side of the coin of what we're talking about is obviously software, right? AI has driven, I think maybe the story of the first half was the quote unquote SaaS apocalypse. A little bit dramatic, but we'll use it here. So markets clearly pricing significant uncertainty, which I think is fair. Right. You had the software, sector trading at 40 times forward earnings. That was basically double the market. Now it's closer to market. Clearly, markets are pricing uncertainty as to the technological future, which seems reasonable. I think the intersection with private markets there is obvious over the past, again, 5 to 10 years, as you've seen sort of simultaneously the growth in fund sizes and the amount of capital that needs to be deployed alongside the growth of the SaaS market overall. Those two things have collided, and you've had, the largest strategies within private credit and private equity deploying lots and lots of capital into software companies because they were good companies. Mm-hmm. They were growing fast. They had, low LTVs, easy to underwrite, right? So it was a good business. But now we're in this different world where there's questions about the future of the business model. You've got, if you look over the past 6 years, 27% of the capital deployed into private equity mega buyouts, so $1 billion plus mega buyouts, went to software companies. Right. So it's become the biggest exposure within some of these larger strategies, right? So that sort of begs the question, as we look forward, I guess, firstly, what is your broad view of this software question, if you will? And secondly, what do you view as the big risks in terms of, whether it's on the credit side or the equity side? What are the big risks you see some of the managers who have more exposure there facing over the next few years?
Yeah, so you highlighted all the reasons why it drew so much attention to begin with by both the private equity and growth equity markets, and even the private credit managers who undertook ARR loans and so forth to the software sector. Yeah. These businesses look very attractive on all the bases that you outlined. We don't know the answer to what will be the ultimate impact of AI on the software industry, but you can start to look at some of these software companies and what they sell to enterprises and end consumers and ask yourself, is this something that could be done by one of the LLM managers, the LLMs out there, and say, is this something that could be better or more cheaply done by Anthropic than by this software company? And the challenge, though, is many of these software companies are already embedded in the workflow. They have the loyalty of their customer base. They together have created a proprietary data bank. They're using it live. The software company can still change its pricing model to stay competitive vis-a-vis the alternate route of using something else. There's a lot of moats that these software companies have created for themselves, the more they've been used by enterprises and consumers over time. There will be a subset of software companies who will be disrupted. They're doing routine things, automated tasks, fairly straightforward, tasks within the workforce that can be done by, one of these models. And if you said that number was, I think Morgan Stanley had a number of like 15% of those. Yeah, it might not be comfortable if your entire existence was, underwriting private equity in software, and that was your exposure. And you had to, look at your portfolio and say, there's going to be a number of zeros in here because of this. Yeah. If you're a large cap lender to this segment, most of those lenders had, roughly 20% of their exposure to software companies. 15% of that is 3% of your total portfolio. If you said 3% of your total portfolio were literally wiped out. So going to go into default and there'll be no collateral value when it goes into default. You're going to write that off over the next 3 to 5 years. It's roughly 1 point a year for the next few years.
Not calamitous.
So instead of making 9 or 10%, you're going to make 8 or 9%. Because of your software exposure. Doesn't sound like an Armageddon or apocalypse to me. It's unfortunate and needs to be reevaluated. So I think we're going to find out over time that most of these software companies will pivot. They will change their pricing model. They'll harness AI, not be disrupted by it. They're already embedded, loyal, have created, trustworthy relationships, are embedded in workflow processes, have proprietary data. That will ensure that they will survive. The toughest part, I think, for just going back to credit, will be if and when those, some of these companies need to be underwritten again for new capital. Not whether they can service their existing debt, but when they're going to be rolled over. Will credit providers, how will they re-underwrite these companies for the next 5 to 7 years? Right. And that's the one where that's probably the biggest overhang question that I have.
A 30 LTV in 2021 is not a 30 LTV today.
No question about it. Yeah. And the underlying values, will change.
And, to your point, the maturity wall for software businesses picks up fairly quickly here in just a couple of years. We include this in the report. We covered this topic pretty in depth in the report, but it's like 15% of the market, 2028, still outstanding, 15% the next year, and then it starts escalating even higher for the, for 29, 2030. And not sure if everybody knows this, but 2029 is the year of the singularity. So according to Ray Kurzweil,
there you go.
Which, seems like if you're looking to refinance into the singularity, maybe something to think about.
Hopefully we're still doing a podcast, though.
Hopefully we're still doing a podcast. Yeah. But, turning to focus specifically on private credit, kind of software aside and singularity aside, there was a big sentiment shift, at the start of the year that led to significant redemptions among private credit evergreen funds. But when we look at market data, we see fundamentals that still look fairly robust, including in the software sector where, mid-single digit top and bottom line growth year over year. We're seeing that since peak rates have come down a bit, that balance sheets have been repaired a bit. Default rates are actually down, by many account across the space. And you see interest coverage increasing. You see fixed charge coverage increasing. So you lead teams that manage tens of billions of credit assets here at Future Standard. Does this fundamental resilience that I'm describing really match, what you're seeing across our hundreds of portfolio companies?
It most definitely matches the fundamental strength, resilience is there. The sentiment, if you back up with what really, in my mind, drove some of the negative sentiment. It started with this, the issues around these idiosyncratic frauds that were in the market that led to the cockroaches comment. But that coincided with cuts to the rates. And I think we forget that it was really that cut in the distribution rates that started to impact sentiment. And it was a reminder to the market that these are floating rate instruments and floating rate strategies. And that investors who had grown used to receiving, say, 10%, all of a sudden realized they were earning 9%.
Only.
And thought, wait a minute, I thought it was 10. And you realize, well, the Fed had cut rates, and at some point these floating rate funds were going to need to cut commensurate with those rate cuts. And I think sometimes that was just an education gap that was out there. There was fear, again, headline driven, that there would be more credit problems. Again, we didn't see that become a systemic issue, but that fear drove more negative sentiment. And that combination drove redemptions. When redemptions came in and were not all funded, right, because we exceeded the 5% cap on redemptions, that stoked greater fears. This idea of, I thought I could get my money out of these strategies. Evergreen structures never made illiquid strategies liquid. They created a mechanism that had trade-offs within it, but had a very clear redemption cap. But that doesn't matter when you go to redeem and you're not able to redeem. You can understand the impact that that's going to have. And so I think that combination of what I just mentioned fed on itself and created the negative sentiment overhang, which continues to this day. But I want to separate what I just described from what is going on in the portfolio and what is going on in the portfolio, the actual fundamentals, the metrics, the underlying health, the interest coverage ratios of these companies and their servicing of that debt remains very healthy.
So the combination of poor sentiment but good, solid fundamentals at a portfolio company level, to me, that would say there's opportunities out there in the market within private credit. I'm really interested to get your view on what those might be. Well,
this now has created a bit of the beginning of a normalization of terms and conditions for lending. There was a period of time, and it was multiple years, of intense capital inflows into a concentrated group of credit funds that led to very tight spreads, lower covenant and documentation issues, so looser lending standards. And it was mostly coming from the private wealth market. I think the normalization of that and those flows being put on pause is creating a more balanced opportunity set for high quality borrowers and lenders to come together at more lender friendly terms and lender friendly documentation, with a little bit of that heat of that competitive and capital dynamic abating. The opportunity is to find high quality borrowers who you can lend to. And in the middle market, it's a more fragmented ecosystem, right? A lot of that competition that I mentioned was in the large cap, sponsored back, unitranche kind of private credit area. In the middle market area, it's more fragmented, less competitive. And we as a lender are finding opportunities where the companies need capital and they're not there to negotiate to the nearest basis point on spread. They want to work with one party, someone they can trust, who can move reasonably quickly through diligence, underwrite it, and stick with them for, a good amount of time and create a long-term relationship. And it's win-win when you can do that. And that opportunity is more prevalent today than it's been in years. And to me, that's the real opportunity right now in private credit, because private credit is not one market. It's many different markets. And when people talk about private credit, particularly in the media, they make it sound like it's just one big pot of cash and one group of borrowers, but that's not the case.
So Mike, sitting here at Midyear, it was a wild first half. I think we can all agree. There's a lot of risks out there in the market, right? We've talked about concentration, clearly geopolitical risk still out there, elevated inflation. The diversification challenge remains, right? We've seen stocks and bonds positively correlated most of the time over the past 5 or 6 years. And in private markets, I think, entry points, there's no bargains to be had out there, right? Finding the right sort of entry, finding the right segments clearly is sort of the mandate for allocators today. So I'm not going to ask you what's going to happen in the second half of the year, but I think for our listeners, curious sort of as we enter into this new, different, more uncertain cycle, what are some of the most important sort of implications that folks should take away from this discussion?
Well, I think the implications come down to understanding for investors what you own and what drives the outcomes for what you own. And looking beneath the surface of the name you call it, the title it has, the name of the fund or the name of the strategy, and asking yourself, does that exposure make sense in a more uncertain world, a higher rate world, a higher inflationary environment, and understand why. Why does it do better? Or why does it hold its own? Why does it diversify from other things that you own? There should be some very clear logic explained by anyone who's purporting to offer a benefit to you by, hey, put this into your portfolio. Okay, we'll explain why that will work. And I think when you just really try to simplify it down to that, you get much greater degrees of clarity. We're not going back to the old regime. We're not fighting the last war. So just looking at what worked 10 years ago or 5 years ago isn't sufficient. So that's why I think that next layer of diligence is required. Why I think investing in companies where adding operational value will be a great differentiator. Why lending into a more fragmented, less competitive ecosystem will make a lot more sense. Where if you're going to go and invest in this AI infrastructure world, we're maybe looking for more contracted returns that may not produce, 4 baggers or 10 baggers for you, but where returning a secure mid to high teen return with limited downside looks like a really good outcome to you. I think when you can define it in those ways, you can build a much more resilient portfolio.
Yeah. So Mike, thanks for joining the show. I think one of the things that'll really stick with me, other than the analogy of the 3 mountain climbers tied together, which will definitely stick with me. Look for that one in the
I won't be climbing any mountains anytime soon.
Look for that on the social clips, futurestandard.com, LinkedIn. But one of the things that really stood out, and I think is one of the reasons why we're so excited about the show and the relaunch and really the focus of what we're doing here, is you described the situation where folks are sort of doubling down, taking the big swing on the thematic risk as it relates to AI, taking the big swing on individual names. And in some cases, it might be because of a lack of knowledge of other options that are out there and the need to become more informed about what else is out there to solve distinct, discrete portfolio challenges that allocators have today. And our view is that the market is really sort of coalescing in a way, give it the AI disruption, deglobalization, many mega trends around these other areas within private markets where you're accomplishing the objective, but you're getting something else along with it too, be it diversification, kind of a different driver of growth. And I think that is the need for a show like this, to expand that education, to share insights in different parts of the market and underscore why private equity, private credit, private real estate is not the monolith that some might think it to be.
Yeah, and I would say there's a lot more in our mid-year private markets outlook report. We just kind of touched the surface today. There's a lot more, so please go give that report a read at futurestandard.com/insights.
Perfect. Thanks, Mike.
Alan, Andrew, it's been a pleasure.
Thanks a lot, Mike. We appreciate it.